to really cover during that period of time. Therefore, you got some baseline education in some of the financial fields that we deal in. Well, we're back now. We've got a conclusion to the January 5th Georgia election. We've got a lot of things going on with the stimulus. We just have a lot of different things going on that I want to cover with you, in addition to an upcoming webinar that I'm going to be doing on what to do in 2021 because of the economic and the tax changes that all of us are going to be going through, as well as an update to the virus. So with no further ado, we'll get on with today's actually, no, there is actually going to be a little insert. So I've been getting a lot of questions as to, why the beard? Well, we're expecting the polar vortex and really cold weather. So my 6-year-old asked me before Christmas time, she said, Daddy, she says, I loved it when you had that beard. It reminded me of Santa Claus. So I grew it back for my daughter. And I said, hey, why not keep it on for the polar vortex? So it's probably coming off after the winter, but I've been getting so many questions on it. So no, I'm not going mountain man, but made my daughter happy with the Santa Claus for the season. So anyway, let's get on with today's show, and we'll get you some good financial knowledge that you're going to need to know for this year. Well, let's start off with some of the economic indicators that we're going to cover, which is number one, virus update, the unemployment, the Fed decisions, the new government, what's going on with the taxes, real estate markets, inflation, and stock market, and finally, economic mapping. And we're going to start off with the upcoming webinar. So today is a live broadcast, and I'm going to be able to cover some things, but because I cover so many things in a short period of time, a lot of people just don't understand what I'm talking about as to what they can do with their own situation to prevent some of the potential destruction that might be coming down the line. So here's what we're going to do. On January 14th at 4 p.m. Pacific time, we're going to be doing a webinar where you will get to attend. Now, it is only going to be reserved for the first 100 participants, but you'll get to attend and ask questions along the way. So a lot of the things that we talk about today that might not make sense, you'll be able to ask about questions. If you want to register for that, all you have to do is go to our main website, which you can see in the top left-hand corner in the URL, which is hhrdm.com. Again, it's hhrdm.com. And just go over to that little More button on the right-hand side, click on that, and then click on Events. You'll see Webinars, and then you'll see the place where you can actually sign up and get in there on the slots before the 100 expire, or before the 100 reservations sign up. Okay, well, let's get on with our economic mapping. Now, I've been putting this mapping together since the end of February of 2020, and there's only been a couple revisions, and it was really just the timing of the revisions. So far, and when I got into this, if you remember, I said if I hit this thing about 70 to 80%, I'd be extremely happy. We're coming in at about 90 to 95% accuracy on our webinar, or on our economic mapping from what we put together last February. And so I'm going to give you what I see is the algorithms that we're working out should show where we land with different things throughout 2021. All right, so back in 2020, we outlined when we anticipated the virus vaccine would come out, which was November, December. That hit. Some of the delays in the disbursement of the vaccine have not changed our algorithms, because our original algorithms did not put that vaccine at critical mass until about April or May. And even with some of the delays, that should probably happen. We estimated that last year, when we started this algorithm, that in April, May of 2021, that we would see a downward turn in the real estate market. And then we created an additional version to that and adjusted that version and showed that that would be more around July or August. So far, that is still right on track, because right now we still have 8.4 million mortgages in forbearance, and it's looking like there is going to be a massive amount of foreclosures, which, even if there was a supply and demand issue during the virus, which is why real estate prices shot up, there is going to be a lot more supply coming on the market, because out of those 8.4 million, you'll see in a minute here, with 20 million people are still unemployed, even with an unemployment rate at 6.7%. it is going to be hard for that many people to make up their mortgage forbearances. Now, we don't know what all the details are from the government if they're going to pass down regulations as far as adding on an additional monthly, meaning amortizing what they owe over the period of time left, or if they're going to tack on the number of years that they delayed it. We'll cover that as we see what's happening within Washington. Let's cover what this economic mapping is. And what it does is, for most of you know that I was with a firm that had a very good economic department. And as soon as anything would happen, all of these economists would jump in together. They would start writing their own algorithms, and then they would do statistical analysis. And that's really where I learned this type of economic mapping. This is what you're seeing. You're seeing a culmination of algorithms and different projections in statistical format, all broken down into statistical averages of things happening. And then I put it into plain English for the community, for people that need to know what to do. So real estate we're going to talk about in a minute. And again, that's all based upon supply and demand. And when we predicted this, we predicted originally that it was going to go up in a big, big way. It has. In November, December, we started to see about 2% and then 0.6% downward trend in new mortgage applications. And so we are seeing kind of that leveling out effect that we predicted originally. And we predict that leveling out effect will continue into the summer, which is then where we will see a lot of this forbearance come to light. And a lot of these mortgages will come due and people will not be able to handle them. And we will see a lot of houses come on the market. That's flooding the market with supply. The demand will still be there because of low interest rates, but it doesn't matter how low the interest rates get. If you have 20 million people unemployed, you have 8.4 million mortgages in forbearance, and you still have prices that go up. So even if the mortgage rates go down, you don't have the ability for the average person to get a home, not when it's going up by 20 or 30%. So I still believe, and we're following the same methodology personally, that we're holding off on any real estate investment purchases until about July or August, and then we'll get a better beat. Again, the only triggering factor here is what the government does with those forbearances, but we will see a massive amount. Now, I want you to keep in mind that back in 2008, when we saw the massive recession, there was only 1.6 million mortgages at that point that were being foreclosed on. Right now, we have 8.4 million mortgages in forbearance. All right, now let's talk about the other part of this, which is employment. We anticipated that employment would drop towards the middle of last year, and we saw that. And then we saw this surgence of unemployment, or should I say employment. People got employed. December of 2020 was the first drop in 7 months, which I'll cover in a minute. And we anticipate that with the resurgence of the virus, the lack of the vaccine getting out to all the people that need it, we see that, and the continued lockdowns and that philosophy of lockdowns, we see that unemployment is still going to go up. Employment will go down at least until the spring and April or May. Once that vaccine starts taking over herd immunity and we start to see some of the stimulus kick in, we don't anticipate a huge resurgence in employment until the middle of the summer. Again, you got this double dip. We don't see that resurgence at the same time that the forbearance is coming due. But again, that's a trigger based upon what the government's going to do. So here's our prime spot, what you see right now for the purchase of real estate. Now, what do we do if we have something like a REIT that's at a loss? We don't do anything with it. We hold on to that thing and let the thing keep pushing in the dividends because, again, this will be, in our opinion, about a 1 to 2 year recovery. But the last thing we want to do is try to switch categories at this point. Well, as originally predicted, we knew there was no hiding Biden's tax plan. We knew that if he got elected, taxes were going to go through the ceiling. I'm going to cover some of those specifics with you in just a minute. And we also anticipated with Biden winning the election that the stock market was going to go haywire on the way up because of the massive spending that the Democrats anticipated, plus a much bigger stimulus package. And that in itself has happened too. So that is going to continue. We believe that that's going to continue towards the middle of the year. Then we'll see a leveling off because once the stimulus hits and people go spend that money, we're not going to see an upward trend until the businesses reopen. And that's not really going to happen in full reality until the beginning to the middle of 2022. I mean, you take a look at New York City. Over 1,100 restaurants have closed permanently. That's just in one city. That doesn't recover with a vaccine. Okay, that's going to take a lot longer time. So we're going to still see some volatility probably through February or March, and then we're going to see this resurgence of the stock market at that point until that stimulus money runs out. Okay, here's our vaccine update. Got some great news, right? We have AstraZeneca, we have Pfizer, we have Moderna, all out in the market helping people survive. We've got the variant that came out in the vaccine or in the virus. However, Moderna's and Pfizer's vaccine has attested that they are still going to protect us against this variant. But the good news is there's another 7 vaccines that are in early limited stage use, 20 vaccines in stage 3, 20 vaccines in stage 2, and 43 new vaccines in stage 1. So while we are still going through this pandemic, what the medical system is saying is that we will have an endemic. And what that simply means is kind of like the way of the flu. While we've never been able to kill off the flu like smallpox or polio, the flu will continue to vary. This will give a huge market for those pharmaceuticals that are producing that vaccine, but also make sure that we're still we're one up on it, kind of like we are on the flu. But again, the flu is one of the biggest killers in the world and still continues to be, and COVID is a variant of that. But at least now they've got a good beat on the DNA. And for those of you that don't understand, we already had the DNA mapping to the COVID, which is why when we originally made these predictions back in March that there would be a vaccine in November, December, that was based upon the research that we did based upon the DNA mapping and already the computer systems that would be able to remap the engineering of the vaccine based upon what they had in November, December. They originally had some of these original DNA maps of this vaccine, and it was November, December, and the vaccines were ready to roll and just had to go through FDA approval. So we truly believe that the pharmaceuticals and the science community is on top of this. So no matter what variant comes out, we're never going to go through what we went through in the last year. That does not say that there's not some other kind of pandemic out there, but as far as this COVID, I think I'm pretty confident with what the scientific community has a good grasp on this right now. Changes to Social Security. Well, there is a proposal of the elimination of the government pension offset as well as the proposed elimination of the windfall. And these are things that reduce the amount of if you were in what they call the donut hole, or if you were a government or state employee. I know Ohio teachers and a lot of different people were removed or reduced or eliminated from Social Security. So it's one of Biden's proposals is to get rid of that to enable all those people to have full benefits. Also for 2020 going into 2021, based upon the inflation, we're anticipating 1.3% increase to the Social Security. Now, don't let that fool you. When we get to the inflation and the Fed's decision, we're fully anticipating 4 to 5% in inflation in 2021 and 2022. So a measly 1.3% only applied against a small Social Security payment is certainly not going to make up the difference of what the inflation is going to be. Hey, take a real quick break here. If you've just joined us a little bit late, because I know that a lot of people join in a few minutes late, I know I'm covered a lot of content, a lot of information, but listen, if you want to attend a full-fledged webinar, it's going to be 90 minutes, and you can, as long as you get in one of the first 100 people, because there's a limit to the number of people that can attend, you're free to ask questions. See, I'm going to outline all these specific changes in detail, and you can ask questions along the way, which unfortunately you can't do in this live broadcast. Now listen, if you want to get onto that webinar, here's what you do. Go to our website. It's hhrdm.com. Again, it's hhrdm.com. You can see that in the URL of the screenshot in the top left. When you're on our webpage, go to the right-hand side where it says More, click on Events, click on Webinars, and you can register on that page. Okay, hopefully I'll look forward to seeing a lot of you there. Let's get back to our show today. Okay, so economic indicators when it comes to employment. Hey, December, net loss of jobs. We're first month in 7 months that we've gone backwards. We lost 140,000 jobs, and it still puts our unemployment rate at 6.7%. There's still 20 million people that are fully unemployed. Well, the new government, what are we looking at? We're looking at full release. As of the news of today, there's going to be a full release and disbursement of the vaccine and a more concerted effort to get it out there to the people that need it. We're going to see a massive, massive government spend spree, at least for the next 24 months. We're going to see an increase in stimulus, if that it means the $2,000 check, or what the current proposal is to bring back the $3.4 trillion. Remember, the last stimulus passed before the end of the year was $900 billion. They're talking about the $3.4 trillion, 3.5 times what was just passed. They're looking at passing. This will, increase our income taxes. We're going to see with this new administration a huge, huge increase in compliance from the IRS while they're planning on staffing up the IRS. We're going to see a huge regulation in oil, fossil fuels, in travel, airlines, in the financial services, the banking area. Again, that will have a lot more cost, but what it will also mean is for those companies that focus and have revenues in the regulatory area, huge profits for them, maybe a little bit less profits for those people that have to pay for that regulation. So much bigger government. But again, this is only a short-term issue until the midterms. Now, we don't even know who's running in the midterms at this point. Only people have said so. And we don't know if there's going to be any control taken back by the Republicans, but we do know for at least 2 years, this is good news for the stock market. This is good news for the long-term real estate market. It's bad news for the people that will be paying taxes. So where do we stand with inflation? Well, nothing has really changed. Look, the Feds have clearly changed their entire calculation on how they're going to compute inflation. They're going to let it run wild, which we anticipate 4 to 5%. What this really means is that if you have annuities that have caps, that's an issue. If you have long-term bonds, that's an issue. And again, you have to make sure that your investments are properly structured to keep up with, if not exceeding, inflation. Yeah, look, people always come to me and they'll say, I'm worried about losing money in the stock market. Okay, that's a reasonable worry if you are not correctly invested. But shouldn't you also be worrying about losing against inflation? It's a real loss. It's just you can't see the loss. And just because you can't see it, it doesn't mean that it's not there. So look, if I have $100,000 in a bank account and they're paying me 0.5% interest, but inflation's 5%, I lost 4.5%. If I have $100,000 in the stock market and it went down to 94,000 or 95,000, I still lost 4 or 5%. Whichever way you cut it, right? The only difference is once you lose against inflation, it's locked in. You can't make it up. If you lose in the stock market, as long as you hold on, at least you have the potential for it to return to a profitable situation. So again, the goal here is to make sure that you beat inflation. Hey, where do we stand on this current stimulus act? Well, we got a new PPP coming in. We've got mortgage forbearance still until mid of next year. We got a check that's going out to everybody at $600, which hopefully will be increased. I agree. I mean, with looking at the financial devastation, I do agree with the $2,000 check. Okay, I don't agree with higher unemployment because that de-incentivizes people to go back to work. But a $2,000 check doesn't de-incentivize them. It gives them more money to support themselves short term, whereas the unemployment is more of a long-term de-incentivization. Student loans, I don't agree with that at all. By any means, there should not be student loan forgiveness. What does that mean? That means that every single American, and so if you decided not to go to college, you're actually paying for those people that went to college. That's more of a socialistic type of mentality, and as you know, I am not of that mentality. I am of you work for what you get. If you work and you're honest, you get a good lifestyle, but it should not be borne upon the backs of other people, unless you are A, physically disabled, B, mentally disabled. Outside that, if you go to work and you're physically able to go to work, you have the same right as everybody else. I call it an open door opportunity. United States, right? Unfortunately, as a part of that HERO Act, they also are talking about a state pension bailout and state reserve funds. But again, that's very socialistic in mentality because it's going to go to California, it's going to go to Illinois, it's going to go to New York, it's going to go to these states that have failed in their financial responsibility Now every American has to pay for their failure. Okay, so HEROES Act an additional check. They're talking about increasing the check to $2,000, additional support for failing cities. We're talking about student loan forgiveness. The big thing I don't agree with is they're saying no lawsuit protection for businesses. Look, you want people to get back to work, but now what you're doing is you're allowing the creation for the litigation attorneys to create all kinds of lawsuits on these small businesses and claim that you got the virus in that business. So I don't agree with that. I think there should be some coverage. You want to get this country back to work, give the small businesses some protection. And right now, there's continued rent and government loan forbearance if you have an FHA or Fannie Mae loan, okay? Where are we with the economic indicators? Not much has changed on this. Mortgages are still about the same rate. They're fluctuating within about 0.25%. So again, if you'll see on my action list, if you're going to refinance, now is the time to refinance. Hey, if you're joining us late, let me jump in on this so you make sure you don't miss this webinar. Next Thursday, that would be the 14th of January, 2021 at 4 p.m. Pacific time. We're going to do a webinar, and that'll be an interactive webinar where you can join in. You can ask questions on anything you want, real estate, stocks, investments, taxes, estate planning, anything you want. It's going to be to help you understand this entirely new environment that we're in. We haven't seen this kind of change since probably 1987. The Tax Reform Act that back then. So we're going to do that webinar. How you get to there, if you see in the top left-hand corner of your screen, you just go to the HHRDM website, and you're going to click on the right-hand side where you see it outlined in red, More, and then you're going to click on Events and then Webinars, and it'll give you a chance to schedule for that webinar because, again, there is only 100 reservations possible on our technology system. So hopefully you can get on there and get some of your questions answered on what you need to do for 2021. All right, now we're going to get into the potential tax changes. Well, here's some bad news for all of us that are out there and trying to build wealth. We're going to have the potential of the loss of a step-up in basis. That is just horrible. It's draconian. It means that in the past, we could pass assets on to children or heirs, and there would be all the gains would be forgiven. They want to get rid of that. They want to get rid of any kind of house exclusion. Now, this is, again, 1031s have been around since the 1920s. But normally, if you sell a personal residence, right now you get a $500,000 exemption if you lived in the house 2 out of the last 5 years. You also get an exemption on rental real estate if you exchange it for another piece of real estate of same or greater value. You don't have to pay the taxes on it until you liquidate all your rental properties. They want to do away with all that. They want to talk about charging a gun tax to get around our constitutional right of $200 per gun and $200 per clip holding more than 10 rounds. They want to talk about a federal property tax. So this would be taxed onto your state income tax. And the loss of a higher standard deduction of the $12,000. So in other words, right now each person is allowed $12,000, but if they undo the Trump Tax Reform Act, that means we go back to the $6,000 standard deduction. So it really puts a huge change in the way that we plan for taxes. Oh, we're not done yet. Let's move on. We got a higher corporate income tax rate, a higher personal income tax rate. We have stock losses that will be disallowed. We have the Trump tax form reversal. We have no more SALT cap. That's the state and local income tax. We have the good thing is we would have the return of the miscellaneous deductions. That's about the only good thing. That's how people deduct our fees for tax accountants, for financial planners. They were able to deduct those. You couldn't under the Trump tax reform. So that's a small number. But that is planning on returning. There will be the return of the health care penalty and tax. So that goes into Obamacare, that you have the right amount of health insurance, otherwise you pay a penalty. And then the reduced cap on the adjusted gross income for the cost that you pay for health insurance. That doesn't help us. You prefer dividends. Right now, if you have a preferred dividend, you're only taxed at the capital gains tax rate. And if they're going to increase the capital gains tax rate to double what it is right now, basically back to ordinary income tax rates, it means we lose that tax preference on dividends. And then the killer, the big knife in the Dracula, right, is the estate tax. So the numbers are floating anywhere between $1 to $3 million in total estate tax exemption. Remember, right now, that total is somewhere around $23 million you wouldn't pay estate tax. And it was due to sunset back to about $11 million per family in 2026, but now they're talking about bringing that back to a total of $1 to $3 million. I mean, you could have a house for $1 million and there's $1 million. I mean, it's, a millionaire today is not what a millionaire was 20 years ago. And then shortening of the IRA distribution period to children. This would fall under the Secure Act, where it's 10 years now. They're talking about bringing that back to 3 to 5 years to raise tax revenues. Again, the whole idea with this is basically to eliminate any kind of tax deferral. Now, this might also bring back the use of a corporation, where we would use that to manage assets, manage real estate, because then we could use a pension plan. Then we could use it to reduce medical costs. We could reuse it to provide asset protection. And we could also use a corporation to actually increase your Social Security income. All we do is we set up the corporation, we run a payroll through it, we optimize it so that you have more of your AIME, which is the calculation that's used to produce your Social Security, and we can increase your actual Social Security. All right, let's get on with today's stock market, right? Hey, nice year, nice end of the year. I want to point something out here, though. Look at this. Let's look at this number here. Back in March of 2020, we had a downward trend. At the highest was 31% down. If you were with us, you weren't freaking out because we used the bucket system and we had 3 buckets. Bucket 3 went down 25%, but bucket 1 and bucket 2 were barely even adjusted at that period of time. That's why we're getting calls by clients going, gosh, the market went down 30%. I'm like, yeah, you're down 4.5% or whatever the number was based upon whatever bucket you were in. And they're like, well, how did that happen? It's not our geniusness. We're not market timers. We didn't figure any special way out to figure out the market, but you just had a certain amount in short-term bonds, a certain amount in preferreds, convertibles, and intermediate-term bonds, and then other parts were in the market. That's the bucket system, right? That's why it worked out so well. The higher the buckets you go, the more risk you took. The lower the buckets you went, the less risk you took. Anyway, you were down 31%. Hey, look at this number here. Going back, 2017, the market was up 21%. This is the S&P 500. 2018, it was down 4.38, but 2019, it was up 28. Look at this. Dow was up 7.3% after the virus, that horrendous year. S&P up 16.3% after that horrible year with the virus. And the NASDAQ, because it's primarily or almost all tech-driven, and a lot of the money went into tech to accommodate for people staying at home. That was up 43%. Not bad for where most people thought we would end up back in March. All right, actions to take right now. Got to change the portfolio. Look, if your person has not changed the portfolio to accommodate for what has happened in the last 12 months, you need to move on. You need to make sure that those categories are correct. Listen, I loved 8-tracks. They're not around. I loved CDs. They're not around. I loved cassettes. They're not around. Now you just press a button, you stream. Things change. You got to adjust to that change. Refinance your real estate right now as fast as you can. Consider Treasury inflation protected securities as a major cash or short-term holdings while the Fed is making their adjustments. Consider reverse mortgages right now. This will set you up to buying real estate. Reduce any long-term bonds and intermediate-term bond allocations. And definitely, please, if you've got existing annuities, analyze those annuities for the ability to fight inflation, which is including annuity swaps and tax plan. Listen, you've heard the old saying in the real estate market, right? Location, location, location. Right now, the number one thing is tax plan. That's got to be your number one goal for the next 2 years to hold on to what you have. Otherwise, it will go away. Hey, before we wrap up today, I want to tell you one more time about January 14th at 4 p.m. Pacific time. I'm going to do a webinar. It's going to be 90 minutes long. It'll give everybody the opportunity to ask questions along the way on some of the strategies, what to do with your taxes, your trust, your estate plan, your investments, etc., even insurances. We'll talk about all those different areas. How you reserve, because we only have 100 reservations available, just go to our website. It's hhrdm.com. Again, it's hhrdm.com. Just click on the right-hand side on More, click on Events and then Webinars, and you can get on that registration list. Hey, last before I wrap this thing up, if you have not yet subscribed to my YouTube page, just Google H&H Retirement on YouTube. You're going to see a page very similar to this. and you can just hit subscribe. This way you can get all the videos. So in case you can't attend this, or you want to watch it a little bit later, or you want to watch part of it now, part of it later, just hit subscribe. It'll get you, make sure you're alerted every single time that we're on. Hey, before I wrap up today, this is off to a fantastic year. I'm disappointed with what happened with the Capitol. Actually, kind of disgusted with what happened with the Capitol. But we're moving on. Listen, we got a vaccine for this virus. We're going to save a lot of lives. We got a lot of money. The government's going to be spending a lot of money. The government's going to be pumping into the stock markets. If you want to be a winner this year, figure out how to capitalize on all the money going into the markets, but protect yourself from the massive tax wave that's going to be coming, and then you win on both sides. With that in mind, have a great weekend. Signing off.